Good evening, everyone. Apologies for the delay. We had a minor tech issue, but we're getting started now. So, on behalf of Axis Bank, I welcome you to the 20th edition of Treasury Market Talks. We at Axis Bank have been instrumental in serving a wide spectrum of customers through its innovative financial solutions and products. We cover large and mid corporates, SMEs, agriculture, and retail businesses. Axis Bank has leveraged the power of technology to provide uninterrupted, best-in-class services for its wide customer base, and we aim to equip clients with high-quality inputs around emerging issues. As part of this aim, we have Treasury Market Talks. We regularly hold events with well-respected thought leaders within the macroeconomics, geopolitics, and market space. In the past, we've been honored by the presence of many eminent speakers. Nobel laureate Professor Stiglitz, Professor Michael Pettis, who's an expert on China, Professor Otmar Issing, who was the ECB's first chief economist and an inflation hawk, and Baroness Ashton, who was the EU foreign policy chief. This talk series has been received very well by all stakeholders. Great enthusiasm and participation from leaders in the corporate world, as well as other diverse fields. Today we discuss developments that take a lens to the Indian economy as well as the global economy. We look at the year that went by and expose themes that can drive medium and long-term developments. We're privileged to host Dr. Arvind Subramanian, Senior Fellow at the Peterson Institute for International Economics and the former CES of the Government of India. There's Dr. Mridul Saggar, Professor of Practice Economics at IIM-Kozhikode and former Executive Director at the RBI, and I must mention also MPC member of the RBI. Speaking with Dr. Subramanian and Dr. Saggar is Neeraj Gambhir, Group Executive, Treasury, Markets and Wholesale Banking Products, Axis Bank. Now, housekeeping announcements before we begin. Participation is by invitation only. Bank reserves the right to block access to any person to whom an invitation has not been sent. Unauthorized dissemination of the content of this webinar is strictly prohibited, and prior explicit permission is imperative. As a reminder, all participant viewing panels will be in the view-only mode. Participants who wish to ask questions may post them on the question box on your screens. Please note, the conference is being recorded and may involve the presence of the media. On behalf of Axis Bank, I once again welcome all our customers to this event. I now hand over to the forum to Neeraj. Thank you, and over to you.
Thank you, Tanay. Very warm welcome to Dr. Arvind Subramanian and Professor Mridul Saggar. Thank you very much for joining me today. Well, the agenda for today is that we are going to do a little bit of look back at what happened in the last year, but mainly we're going to talk about what we expect to happen in the next 12-24 months as we look forward, both from a global macro perspective, but a lot more focus on how Indian economy is shaping up and what are the key variables that we're going to watch for. So to start off with, let me just quickly summarize what FY24 was for the global economy and Indian economy before I turn to my guests. The largest economy, which is that of US, grew at the rate of 2.5% last year, which was largely on the back of a significant fiscal spending that was undertaken in US post-COVID. Inflation stayed elevated at a rate of about 4%, and an unemployment rate was at a pretty low level of 3.6%. At the start of the year, many were expecting US economy to suffer some kind of what is called a hard landing, given the size and the pace of monetary policy changes that were done. But it doesn't seem to have had any kind of effect at all. There was also an expectation that somewhere in the end or towards the middle or the end of 2023, we will see Fed starting to cut rates, but that hasn't materialized. And in fact, as we get into the fiscal 25, the first quarter itself has seen a significant revision of markets' expectation of rate cuts from Fed later this year. Start of the calendar, we were at 140 basis points rate cuts for the year. Currently, we are somewhere close to 40 basis points for the full year. So there is a significant revision there. On the other hand, in the Europe, we are seeing growth slow down significantly. The expectation is that 2024 growth will be less than 1%, actually at about 0.5% or so. And inflation will be milder at about 2.3%. So it does look like that European economy is undergoing some bit of a cooling down or a significant bit of cooling down as a result of the monetary policy medicine that has been given there. And therefore, the current expectation is that probably it will be ECB, which will kick off the rate cutting cycle much before then even Fed goes, and probably will actually cut rates by roughly 70, 80 basis points through the rest of this calendar year. The third largest economy, China, or actually second largest economy, China, seems to be in a funk of its own. Um, the growth seems to be quite muted. There are a whole host of issues, including, problems along the real estate and issues in some of the other sectors. And it's not very clear what path Chinese economy will take from here. Growth certainly seems to be quite muted. But unlike in the past, this level of low growth is not being buttressed by any kind of significant policy boost. So markets have been expecting Chinese, policymakers to do something about the low growth, but it hasn't been as much forthcoming as it was expected. A quick look at India. I think we seem to be the fastest economy in the world right now. Annual growth for 2024 was estimated at 7.6%. Though there seems to be some kind of a statistical quirk here between the GVA and the GDP estimates. GVA estimates indicate somewhere closer to 7% growth. There has been some kind of a capex skew to this growth. It seems to be largely driven by government capex spend. The much touted or much expected corporate capex spend has not yet materialized. Average inflation for the year was roughly 5.5%, but we are seeing a very high quality, seems to be sustainable core disinflation. So even though the headline is still much higher than where the policy, where the target is, the core seems to be sustainably on the downward trend. Exports are doing well. Core goods and services both seem to be holding up well. And we've seen a very significant contraction in current account deficit in this year. In fact, the current account outcome for this year and to some extent a part of the last year has actually positively surprised the market, if I may say. On external front, rupee has been one of the most stable currencies in FY24. And part of this could be on account of the fact that Reserve Bank has been very active in the currency market. And there is an equally elevated expectation as far as growth is concerned for FY25, if you go by some of the official forecasts of growth. And the forecast of inflation is that will probably come down to somewhere close to 4.5% by the end of this year. But we have a lot of uncertainties to deal with as we look forward to FY25. First and foremost, we have two major wars going on at this point in time, one in Europe, one in Middle East. And the Middle Eastern one seems to have taken a turn for the worse over the last, I would say, 2 to 3 weeks. And it's still not very clear whether, how far things will go there. On top of that, we have a large part of the world, roughly 49% of global population, which is undergoing elections. And the largest one of them is going to be in US. And the outcomes of these elections, and particularly the US one, will have a strong bearing on how life plays out post-November. We are seeing some reversal in commodity prices. Crude oil has actually jumped up to about $90. There is also a significant pullback in pricing of copper, aluminum, gold, which is kind of worrying people that whether this will start seeping into the inflation process as well. So there is a lot that we need to decipher to think about what next year will bring to us or what this fiscal will bring to us. And to help us understand all this, we have two very eminent panelists here. So let me first turn to you, Arvind. Help us understand how you see US events, which seem to be the focus of the world at this point in time, in terms of growth, fiscal, the outcomes of elections, and its impact on global growth and macro. So if we can start from there, then we can actually move to the other parts.
Yeah. Thanks, Neeraj. Thanks for having me. It's great to be here. I think you've summarized the global economy very well. Let me pick on, I think, one or two things that I think we should be especially looking out for. Um, the first is, I think that from the point of view of the global economy, growth is chugging along. There's nothing unusual about it. The IMF has said that most countries have done reasonably well. Some have been scarred more than others. The US has escaped the scarring, but otherwise, things are chugging along. Nothing kind of dramatic. Um, I would emphasize two or three big points to think about going forward. One is that China, as you said, is in somewhat of a terminal trend decline in growth. I think that's going to be important for India in many ways, including the fact that I think the China plus one opportunity is only going to increase for India. I think that's one thing that we should look out for. We'll discuss later. The other thing is that, because of so much excess capacity in China, I think it's going to have, in global macro terms, a kind of disinflationary impact on everyone, including on India. It's going to be a challenge. On the one hand, it's going to provide a disinflationary impulse, but on the other hand, it's also going to lead to a lot more trade conflict and allegations that China is dumping, et cetera, et cetera. So our manufacturing, in that sense, global manufacturing, is going to be affected by the state of the Chinese economy. So that's one. The second thing I think is that with US inflation still stubbornly elevated, as you said, that the prospect that US interest rates would come down, that having been a little bit taken off means that's going to have this whole thing about divergence, monetary divergence in the global economy is going to be a feature, or it's not going to be reversed very quickly as we'd anticipated, which is going to have an impact on capital flows around the world. So the continuing kind of monetary divergence or monetary policy stance divergence because of high US inflation is going to have an impact on the world. One more thing I would say is you were speaking about the US election and things. I think it's becoming clear in terms of the global outlook that regardless of the outcome of the of the American election, we are in for a world where American policy is going to be much more. There is a bipartisan consensus on China, or rather against China, which means that regardless of who comes into power, we will continue to see trade tensions. Of course, if President Trump comes in, maybe the trade tensions will get more elevated. But I think the US is going to double down on the fences it's creating against China. Maybe with more protectionist action, and we're going to see more and more industrial policy and protectionist policy in the United States, which is going to have a big impact on many countries, including India. So to sum up, kind of nothing big happening that except the China excess supply, the China decline, the fact of US and maybe even more European policy becoming more aggressive towards China. But the global landscape going forward is going to be, I think, somewhat unsettled. Apart from the shocks that you spoke about, is going to be, I think, in the shadow of these continuing and perhaps rising trade tensions between China and the rest of the world.
Well, thanks. That's very helpful. I want to bring Mridul into the conversation now. Mridul, how do you see global inflation play out across major economies, right? I mean, there is obviously this whole narrative that is going on in US that maybe the the benefits that we saw of disinflation in produced goods, right? Other the services sector inflation was stubborn. Maybe that is behind us now, and we could see some pullback, in terms of that disinflation process. There is this whole story that Arvind talked about in terms of China dumping goods and China creating more and more capacity. That should have the opposite impact. So, how do these things fit together in your opinion, as far if you look at the broad brush global, inflation view?
Okay. Neeraj, first, let me thank you for inviting me to this webinar. And I do look to a great conversation with Dr. Arvind Subramanian and yourself. And to answer your first question, I think the worst seems to be over as far as the inflation concern is there. See, we have to see it in historical perspective that central banks were caught behind the curve. I mean, undoubtedly, they were caught behind the curve. There was just too much fear about the scarring of the pandemic, and the central banks did not recognize that the potential output having fallen, the output gap closes early, and they were not prepared to tighten. They wanted to recoup all the lost output, and that was a big mistake. But in all honesty, central banks actually made up for that. And when the Fed started tightening, the call was very clear that they would like to engineer a recession and get on top of the control of the inflation. Now, it is remarkable that they have done that without any recession. I mean, forget the technical recessions which the markets talk, but this is not at all a recessionary scenario which emerged out of it. The disinflation has been significant. I mean, CPI inflation in US is down from 9.1% to 3.5%. In Euro area, down from 10.6 to 2.4. UK, it has fallen from 11.3 to 3.2%. And Japan also suffered from 4 to 2.2% before the wage hike put it back to 2.8%. The 2% inflation targets now seem to be on the horizon. But I think the last mile will be very hard, and it may not very be appropriate to do a large output sacrifice in a hurry to push it to the 2%. So I think the central banks are getting it right to keep it on hold for the time being. So there is no hurry to cut, there is no hurry to hike and attain the targets. And that's what will happen with the Fed. So Fed will have a delayed cutting action. And you were right in saying euro area might cut because growth is abysmal there. I mean, you're at 0.1% this quarter, the fourth quarter after large contraction, is not a good sign. And their inflation now is under reasonable control. So maybe they will bite the bullet first. But I don't think any central bank is likely to cut in a hurry. And that applies even to the Reserve Bank, for instance, and the emerging markets at the long. Sorry, you wanted to say something, Neeraj?
I'll say that I'll come back to the monetary policy a little later because I want to have a slightly detailed conversation on monetary policy.
Okay.
But it does look like that your view is that the gains that we may have made on the inflation so far, of course, we've seen a big slide in terms of the headline inflation numbers across the world. These are indeed enduring, right? And therefore, the next path or the next step for central banks will be a cut. It's only a matter of time, and maybe they'll be a lot more patient about it. But you're not basically seeing, the geopolitical tensions or the commodity price boom that we are seeing right now, bringing us back to moderately high level of inflation. I'm not talking about the 7 and 9%, but say 3-4% kind of inflation in developed world.
That's possible, Neeraj. I'm not ruling that out at all. So we have to understand the baseline and the spreads along that from the fan charts or the risk around that. And clearly, if there are geopolitical disturbances and supply chain gets disturbed, if you see the shipping data very closely, it's still not disturbed very much despite the Houthi attacks in the Red Sea.
Yeah.
So let's keep our fingers crossed on that. But then from the political angle, which you both were talking about, if Trump comes back, there is a chance that some resolution of Ukraine might occur, maybe not very conducive to Ukraine or the Europe, but the politics could take a big turn on that. So that may be a positive delta for the economy and the finance.
Yeah. So
I
Arvind,
think the game then is the Taiwan and Middle East, yes, of course. Yeah.
sorry. So Arvind, I think I'll come back to one of the points that you made about China plus one strategy, right? You said that China seems to be in a sustained downward trend, and this creates an opportunity for us to go after the China plus one strategy. And, the world has been talking about India as the potential, but we're not seeing that play out in our FDI numbers, right? Net FDI data, if you see, seems to be weak. Even though recently there was some news item that Apple has started exporting iPhones worth $14 billion out of India, right? That seems to be a fairly significant number. But on a macro basis, it doesn't look like that FDI has seen a significant, there has been a significant change in the net FDI numbers over the last 2 or 3 years. So what's your take on that? Is a policy set right? Is there something that we need to do differently to really take benefit from that?
Yeah, I think, Neeraj, I would say that there are two related things which are puzzling, right? One is that both FDI has declined quite sharply, right? And it's not just FDI as a share of GDP, but the share of India in global FDI to emerging markets, excluding China, has also declined. So that's a little bit more worrying. The second thing which you mentioned was also that overall private investment, private corporate investment, is kind of stagnant, right? Because even the investment push has come in from the government sector. So I think the big puzzle is, why is it that if growth is doing so well, if people are so excited about the Indian economy, why are both and the China plus one opportunity and the banking system has been cleaned up? So in principle, that should not constrain, the funding should not be a constraint. So it is a very big puzzle why both FDI and my tentative answer to that is twofold. One is that I think while the government has done very well on building the hardware of the economy, building up infrastructure, providing incentives, etc., I think that the playing field is still not level in India. There is a sense that some are favored more than others. There's also policy instability. One day something may happen, the other day policies could be reversed. So the sense that the playing field, both a stable regulatory regime and a regime that's not arbitrary, that's not selective in its application of things, I think is still in the back of minds of certain investors, especially the medium-sized investors who are, and we've seen plenty of evidence or at least anecdotes of this kind of playing field not being level between investors. I think that's the first point. I think the second point also is that we have seen the Indian economy from about 2018 turning inward. Tariffs have gone up, restrictions have gone up. I think in the latest budget, to be fair, some of these tariffs have come down, especially on inputs for electronics. But overall, the stance of the Indian economy of policy is inward oriented. So I think there is still a doubt whether we can be globally competitive with a policy regime that's somewhat uneven in its implementation, that's somewhat arbitrary. Targets some investors over others, and that's broadly turned inward. Is this a combination that can sustain high levels of investment? I think that's kind of the open question, I think, and that we will see in the months ahead, whether that's going to change or not.
Yeah, although I wonder that if Apple can do it, why can't others? In fact, Apple is known to have the most exacting standards as far as production is concerned, right? And
So, yeah. So, Neeraj, can I respond to that as well? That's a very good point.
yeah.
See, I think we need to. I've been recently in Tamil Nadu as well, where you do see some early signs of other companies also coming in. So maybe one possibility is that it's just down the corner. It's going to come. It's going to increase, and we're just waiting for that, right? But I would not take complete comfort from the Apple thing, is because it's part of the same argument I'm making about the level playing field. Maybe Apple and the big names are, their things are protected, but for the regular investor, maybe things are a bit more difficult. So when I say uneven playing field, it's not just between some domestic investors and others, but also some foreign investors also may be kind of very well treated because they have all these reputational impacts and so on. So I think what I'm saying, therefore, is that there are early signs of improvement. I think we should watch out, but I also think that the sense that the regime is stable and non-discriminatory across the board, I think that's very important.
No, good points, Arvind. I think clearly that's a question that we'll all be looking for an answer to in months to come. I will turn back to Mridul. Mridul, I interrupted you when you were talking about India inflation and India monetary policy. I wanted to actually go back to the point on India inflation. There are three things here. One is obviously the fact that we are seeing a certain amount of consolidation in the fiscal side, right? So this year, the budget has been praised a lot for the fact that the government has gone that extra step in terms of fiscal consolidation. But we are also seeing a lot of uncertainty and volatility around the food prices front. And, there is concern that climate change, whether it's El Nino, these are all kind of things that can bring a lot more volatility to the food prices. And thirdly, any geopolitical event would eventually lead to higher oil prices, higher commodity prices. All of this not very good for India. So how do you see India inflation story play out? I mean, we had this divergence between core and headline. Do you think that will continue or that will converge at some point in time?
So, Neeraj, sorry for this one. I'd come to your inflation question, but I lost connection in between. So let me come back. And I like this concern on the FDI, which was being discussed. I'll give you a short perspective of mine on that.
Sure.
And basically, yes, the net FDI in India is down. But if you see the gross numbers, they're not down at all. So if you see the April-January data, the run rate is the same as the last year, and which means a pretty good number for the full year. So what's happening here is that repatriation is increasing. The repatriation is increasing, and also the outward FDI has been making dent for the last couple of years because outward FDI has increased a lot. So I don't think we need to panic about FDI slowdown at this juncture, especially because if you're seeing the UNCTAD, the UNCTAD report, which came out in January, the global FDI is also expected to be weak. So that's more a translation of that. We are seeing significant interest in investments in India, and I hope India lives up to that interest. That's how I would like to put it. I mean, if basically we have the Tesla CEO coming at the end of this week, on this weekend, Sunday, I mean, there's a lot expected. I mean, this is a sort of signaling which is working with the global investors. So let's not be completely despondent on it, but let's recognize that what we need to do needs to be done. Coming now to the inflation front, basically, you're right. I mean, climatic disturbances have caused havoc with the India inflation in recent years, and this is something we can't rule out. On the El Nino, clearly, both the IMD forecast, if you have seen, at 106% of LPA. So, and basically the private forecasts are also around 102%. So that means the base case seems to be a normal monsoon. And one can put more money on that, though I'm really not going to put any money till we have the numbers on area sown, which comes around July, to know where the agriculture is standing. And you could always have that phenomena of late rains destroying the pot crop, the potato, onion, tomato, which has happened in recent years. So inflation could again turn volatile. I'm not so optimistic of the full year forecast which the street is giving or the RBI is giving. There could be an upside to that if any of such events happen, but then one can't really know what those events would be and whether they will happen or not. But the pace at which core inflation has fallen is something we can't sort of neglect in the analysis of the inflation. Inflation had been sticky for so long because, Arvind, you want to say something?
Yeah. Maybe, Neeraj, I can maybe complicate the question a little bit.
Yeah, sure.
For Mridul, I think maybe you see, there is a counterpart, just as you said, Mridul, that in the US we had immaculate disinflation. There is a puzzle in India about why, core inflation has declined so steadily, despite growth being so accelerating, as it were. So the puzzle of there's a counterpart to the immaculate disinflation in India too. And I would love to hear, because I think our diagnosis of what's going to happen on core, especially going forward, has to some extent be, related to our understanding of this immaculate disinflation within India, which is a bit of a puzzle. I have an explanation for the puzzle. I have an explanation for two puzzles, but I would like to get your view on this puzzle because you're the expert on this.
No, Arvind, if you want to explain the puzzle, by all means, go ahead, and then I'll give you my perspective. So that's okay. I mean,
Neeraj, is this okay if we pursue this?
Please, go ahead.
See, in fact, there are two puzzles in India on the macro, which all of you may be following. One is, why is core inflation coming down if growth is so high and rising? Second is, why is growth so high if consumption growth has been so poor? So there are two puzzles, and Axis Bank's Neelkant has a explanation for the second puzzle about it's now all investment-led growth, etc., and that's possible as well. So my explanation for both these puzzles is actually very simple, that we're just overestimating GDP growth. If growth were 4 to 5 rather than 7 to 8, then both these puzzles kind of disappear. And so instead of having two very contorted explanations for two puzzles, you have a simple explanation for both puzzles. And that would be my, cautionary tale to investors that, actually the measurement issue is not something we can brush aside. And that, if you see that it's more, I think we're doing well. I think there are all these deflated measurement issues which are distorting the growth numbers. And if you take that into account, 4 to 5, then both these puzzles sort of get answered. Otherwise, you have to come up with really complicated explanations for why these puzzles are there in the first place.
So, Arvind, I would sort of agree with your cautionary note, but I will also want to introduce the caution on the cautionary note. So, it's true that probably the GDP may have got overestimated. It's hard to measure what exactly is the overestimation, but we know that the services deflator in India is so poor, there is virtually lack of information on that those biases could be possible. But caution on the caution is, I don't think the growth in India is like 4-5%. That could be a problem with the China measure of the GDP, but not the India measure. If you see the data very, very closely, and I've done that sat with the so basically my impression would be it could be on a ballpark at 1%, not more than that. So, which obviously would not fully explain the fall in the core inflation. But then, as you pointed out, the PFC growth has been dismal. That has not really added to the aggregate demand in any significant way, and that is what we need to bit worry about, because that has a larger impact on the core. So I'm also, while investment is picking up, I don't see investment is picking up as much as to say, oh, we are having an investment boom, or we can go gung-ho on the investment and say, oh, that's what is explaining the entire puzzle.
No, great conversation. I think thanks, Arvind, for bringing that element in. I think although I would say that as a banker and what we see as a bank, there is, I wouldn't say that we are in a very low or middling low growth regime at this point in time. And I say this because of the kind of credit demand that we are seeing, both on the corporate as well as on the retail side. Particularly in the corporate, it is not very high, but it is not very muted either. Retail, as you know, if you look at all the bank balance sheets, I think you will see that pretty much retail is leading the credit growth in this economy, and most banks are in 20% plus or thereabouts, right? So even though people say credit is a lagging indicator, even if credit is a lagging indicator, I think that we are in a very mature economic growth cycle at this point in time. It's not as if we are at a lower end of it. So on this one, I would probably side with Dr. Saggar.
But Neeraj, can I push back that as I understand it, real credit is doing very well, as you said, it's booming.
Yeah.
Real credit to corporates, less so, right? So, and in fact, to the extent that the RBI is a bit concerned about the growth in, right? But if real credit for consumption is growing at such a rapid pace, why is private consumption so weak, measured private consumption? There's a third puzzle here.
Yeah, you're right. I mean, I think the narrative that we hear is that rural incomes are lower, it's a K-shaped recovery, etc., etc. So, but in some senses, I think the urban India seems to be doing fairly well.
Yeah.
And there is a certain amount of, consumption trend there on the urban India side, which is getting reflected in, for example, the unsecured loans, the personal loans aspect of it. Rural probably is a bit weak, and that's what is kind of getting reflected in the broader macro story. That's the only possible explanation that I can actually offer at this point. And I'm not an economist. I am not able to sort of find a deeper meaning into all this in that sense. But I want to press ahead with a little bit of our conversation to say that where is all this leading us as we look ahead for FY25. So I want to start with you, Arvind, to say that what's your best guess estimate of where we land up in terms of FY25 growth? Reserve Bank is closer to 7, private sector, I think most of the economists are somewhere close to 6.5, right? So there seems to be a divergence between what the central bank is looking at and what the private sector seems to be thinking about.
So my sense is that whatever is the growth rate this year, and I kind of disagree on the measures, but let's leave that aside. Whatever the number you have for this year, I think it's going to be no less next year. It's going to be at that or a little better.
Yeah.
And the reason, I think, let me point to actually something significant that's changed on the macro in India's favor. I think, and this you alluded to, Neeraj, at the beginning, is that the current account situation now, I think we are moving to a situation maybe of structural improvement in the current account. If you compare the current account balance today with, say, maybe 5, even 10 years ago, our trade deficits used to be very high, and the services surplus used to be, kind of partly compensated. But now I think it's the services component of that is doing so well that one could now speak about a current account situation that no longer needs to be as much of a constraint as it used to be in the past. And what it therefore means is that the central bank, and Mridul, correct me if I'm wrong, the central bank has a little bit more leeway to cut rates because your structural situation is better. You don't have to worry as much about the rupee as the RBI has had to do over the last a year or so. So I think therefore if we have the fiscal consolidating, if we have the China plus one opportunity improving, if we have this structural balance improving, which gives more room for a policy impulse, then I think next year is going to be certainly going to be as good or better than this year. That's all I can say. Whether that's half a percentage point or 1.5, I don't know. But it's certainly looking better than this year, I would say.
So you seem to be more in the camp of RBI, which seems to be very, very confident of growth actually next year. Much more confident than the private sector is, and we are reminded time and again by the RBI governor that they have been more right than everybody else as far as growth is concerned, because they have been.
Yeah, but always subject to the caveat that I disagree with all of you on the magnitude of growth.
Itself. Right, I get that.
But the delta, I'm more with the RBI on the thing, which is. And for the reasons I outlined, I think that the current account is doing really well, I think,
right,
in a structural sense.
So, Mridul, I'll take it from there. And, if the growth is doing so well, core inflation is low, what's your take on monetary policy in India, right? I mean, but before you answer this, I'll tell you what a lot of us are thinking in the market so that you can actually put that in context for us. The dominant thinking in the market seems to be that India will not move on rates unless and until Fed moves. And once Fed moves, I think it will open up space for India to do something. The most people seem to think that there isn't a lot that needs to be done, maybe 25, maybe 50 basis points post the Fed move. My personal view, though, is that given what's happening in US, I think it looks like when Fed will move, very hard to decipher. And even if they move, and given the growth, as Arvind mentioned, that growth is likely to be stronger, and the headline inflation dynamic in India, do we really need to see rate cuts in India? So I think if you can give us that perspective.
Yeah, so good point, Arvind. I agree with you that maybe structurally India's CAD has improved, lowered down a bit. It's that story has played out longer. Unless, of course, your thesis that the GDP growth is 4%, then one can explain why CAD is low. But I am not in that camp either. So my sense of this story is that it does improve macro leeway for RBI in India, but the simple fact is that the room to cut is very shallow. Even if RBI starts cutting, what is the point in cutting 25 basis point and 50 basis point and then stopping the cutting cycle? India, the real interest rates were negative for too long. And RBI has been finally able to address that. And if you see the real deposit rates, they are marginally positive now. So that's not a bad situation to hold when inflation is not that much of a concern. So to the story of Neeraj, that if Fed cuts, the RBI room increases, my response will simply be that RBI leeway to cut will increase only if growth starts falling in India. I don't think while the interest differential is part of the story, the weight given to interest differential is a lot less what the debt markets think. The debt markets are attuned to that story that everything is interest differential because the bond yields and the bond profits all depend on that. But macro and monetary policies are aimed at inflation and growth a lot more than what the others do. I don't think it's going to cause a great havoc on the exchange rate if RBI cuts before the Fed cuts. It has happened before, and if need be, RBI can cut later. But we have to watch for the oscillation in the numbers of growth and inflation, departures from the projected path to guess what RBI might do. It may end up not cutting for the whole year. It may even cut in June if some signals come. But I don't think June is a little trifle too fast. So one has to wait and see how this pans out.
But you think that by October we'll really get a cut? I mean, if I were to actually really push you on that point, what's your base case for October? Do we see a cut coming by October?
So my base case is not, because I don't see now the global recession occurring, which was my call last year. I in fact thought with the kind of tightening that is required to disinflate US, it's surely going to get into recession. I was honest. To be honest, I was proved wrong there, and that is where basically the difference came. And this time again, if there's no hurry on the Fed path, if growth in US is not really slowing or elsewhere, then India can withstand its growth, not to the projection maybe of RBI of 7%, but maybe we could do 6.7, 6.8, which is again not a bad number.
Neeraj, can I just interject? One thought here is that, see, when I said that the current accounts thing provides more leeway, I don't want to say that that leeway will actually be used. Obviously, what Mridul is saying is right. But I think that, look, if you were a central banker in India today and you saw all the numbers, I mean, it's like a Goldilocks situation, right? Growth is rising, core inflation is coming down. And, and just not to be too cynical about this, the RBI governor, there's going to be a transition coming at the end of the year, if I'm not wrong as well, right? And so I think there is every incentive for the current regime, as Mridul rightly said, to show that, we've followed this policy, it's worked very well. If it ain't broke, why fix it?
Fix it. Yeah. So it looks like there isn't a lot for the monetary policy to do at this point in time, right? Just let this golden period continue as long as it does, right? Mridul, just one quick minute for you. Where do you see rupee? What do you see happening to rupee? I think we've seen a very strong dollar. We've seen it getting reflected in Japanese yen and euro to some extent. Do you see rupee continuing to weaken, or there is some scope for a different view here?
So rupee of late has been remarkably stable, almost to make me worry. I mean, while a lot of people actually sort of take a big plus out of it, to me, rupee is a price, and some fluctuation in it is pretty legitimate. Now, the way rupee is being managed, it may be good in the short run, but not necessarily over the medium run. It can breed complacency. The hedging ratios could fall for the corporate. And when the shock comes, we may be less prepared. But the good part is we keep on building reserves, and we'll be touching 650 billion if we haven't touched. Maybe this weekend's data might tell us. But it's really not to, these are buffers which afford us comfort.
Also, can I just
yeah.
So can I just add one thing on that? You see, I think that what's been interesting about the last 1 year is that while FDI flows have not been so strong, portfolio flows have been very strong.
That's
Right? And I think there are two things going on here. One, of course, the India growth story, obviously in the short run, is attracting investors. But the other thing is there's a one-off India getting onto these bond indices and so on is going to, so there's going to be a one-off, it's not going to be permanent. It's going to be a one-off, boost to portfolio inflows. And I think to some extent, that's what we've seen play out in the last 1 year. The fact that funds are now automatically, India gets a share because it's part of all these new indices. That hasn't worked itself fully out, so I think we're going to get more strong inflows based on that, and that's why I think that broadly I would agree with Mridul that we're probably in for a especially if these inflows keep coming, if anything, the RBI will have the luxury of building up reserves over the medium term. And now, at 650 billion now, it's close to 650. I think our external situation is looking really quite nice and comfortable.
That's
I
great.
agree. Thanks, Arvind. Yeah, thanks for bringing this up. It's just the right thing to put it off.
It's great. I'll have to interject here. I just realized that we've actually spent 50 of our allotted 1 hour, time, 50 minutes of our allotted 1 hour time in discussion. And I do want to take a few questions from the clients who've actually joined us for this seminar. So if you permit me, I'll kind of pause here. Let's see what kind of questions come up from the audience, and maybe that will trigger some more interesting conversation.
Thanks, Neeraj. So there are a number of questions in the rupee since we're talking about the rupee. One of them is from Ashutosh Khajuri of Federal Bank. But they broadly come in the lines of what is the fair value of the rupee and how should that evolve over time fundamentally? And what is a good level of FX reserves to have? Should the RBI allow the rupee to appreciate? Should continue to force the rupee to weaken gradually? Is there a best case path for the rupee going ahead?
Okay. Who wants to address? Should I?
Why don't you go first and request Arvind also to join in?
Okay.
Yeah, Mridul, go ahead first.
So my take is I would be happier to see some more volatility in the rupee than being controlled so heavily. So I think there could be a case for short-term appreciation, as Arvind was also pointing out. Basically, you may get a lot of bond index flows in from June. We are already seeing some of the hedge funds having taken positions. So hedge funds have brought in some of the portfolio flows already. The alternative investment funds are not generally index funds. The index funds would come in a big way from June, and I expect that momentum to even gather pace if Bloomberg Barclays index inclusion is announced in June. So that's a possibility. So I don't expect the FTSE to run and put India into their bond index, but the Bloomberg Barclays is very much on the horizon. Now, that would obviously put pressures temporarily on the rupee. But this is not something which RBI can't easily manage. RBI has been managing all this volatility for so long, even in the worst situations. I think the simple maths which often people do in terms of what are the index funds and 10% weight and into may not really work. There would be plus minus 2 to 3% oscillation on that. We might get a little less money than what the simple maths tell us, but that's still okay. It's still good financing of the current account deficit, and it will help us improve the growth. I don't see that much of a risk into this game. Now, the point also is that over a period of time, if inflation in advanced economies is falling to the targets, it's already near targets. So the inflation differential advantage which we carried over last 2 years is going to go away. And with that happening, some weakening of the rupee is still possible if inflation differential again opens up, be it 5% to 2 to 3%, it's still an inflation differential. So we can expect two-way movements, and that should be actually allowed without losing control of that two-way movement. We have sufficient hedge products, and there can be a market play on that. Markets have to function. So there is no need to sort of giving a put here.
So can I come in? So Mridul, sorry, can I come in?
Yeah.
Sure.
Yeah, I think very good question. 3 questions were asked. What is the fair value of the rupee? Answer:
Okay.
nobody, not even God knows. 1. 2. What is a desirable level of reserves? The more the better. China has shown us the more the better. Although the Russia thing has shown us that your reserves can be taken away as well. But subject to that, I think I would say the more the better. Third, on what is desirable exchange rate policy, given this, I think broadly what the RBI has done over the last several years is actually is what the policy I would follow, which is the following, which is that when there are pressures, when inflows come in, I would more buy and not allow too much appreciation, but opportunistically take advantage of opportunities for the currency to decline gently, because we don't want an uncompetitive exchange rate from an export point of view and a growth point of view. So if you have an open capital account, there are limits to how much you can really control the level of the exchange rate, but to the extent that you can, simple rule, asymmetric. On the flows come in, buy rather than allow the rate to appreciate. But when you get the chance, when flows are leaving, allow some modest depreciation. Obviously, it has to be controlled. Otherwise, there will be panic and so on. But broadly, this asymmetric policy is what the RBI has been following. And I think that's very desirable. And I would commend the RBI for that.
Thank you. Thank you. But I'll just introduce a note of caution that basically the Commerce and the Treasury Department sitting at the place where you are won't allow too much asymmetric interventions. So it's good to have both ways, and that is not something bad. The other point I want to very briefly make is that productivity growths of late have been low. I mean, they have been close to zero. So there is no case for appreciation of a real equilibrium exchange rate from the Balassa-Wilson point of view. And that makes it more, one has to be having an added caution. And I think if you do the Natrix kind or a Stein kind of these models, you don't think rupee value is fundamentally misaligned. They're reasonably okay.
Yeah. Although I just like to add here to say that, theoretical arguments aside, what we've seen is the ability of Reserve Bank to actually manage inflows, outflows increase quite substantially with the level of reserves that we have. I mean, if you look at what happened during COVID times, almost 50 billion went out of the country, and nobody kind of batted an eyelid. We kind of in any other time, maybe 5 years ago, this would have created a huge panic in both Mint Street and Block, right? So clearly we've come a long way, and clearly the deft handling of RBI has a lot to do with the way this has been handled in the past. Tanay, you want to take the next questions?
There are actually a few deep questions. With your permission, maybe we can exceed the time by 10 minutes or so, if it's okay.
Arvind and Mridul, is that fine with you? If you can just 7 minutes over.
Yeah, sure. Yeah.
Okay. Thank you. So there's one from Sridev Ganju from Tech Mahindra. He asks, defense, geopolitics, industrial policy are all going to come. Will fiscal dominance also return? And for everybody else in the call, fiscal dominance is to mean that monetary policy is subjugated to fiscal policy. Is it coming back, and what does that mean for all of us?
Arvind, you want to react? Because I'm very apprehensive of what might happen in US.
Is the question about India or the US?
It's in a sense, the question here is that we are seeing India, of course, we are seeing a fiscal consolidation, so I'm not sure that's that relevant to us given where things are. But clearly in US, there seems to be there is completely an unapologetic push to do more and more on fiscal side, right? And at some point in time, it might feel like that, oh, Fed has to cut rates just because the higher rates cannot be absorbed by Treasury. So that's the kind of view also that is going around, which effectively is what fiscal deficit, dominance is.
Yeah. So there is no doubt that um, the medium term outlook in the US is for much more spending. Primarily coming from three things, right? The green transition, and then defense as well. There are pressures, but I do think that this recent inflationary scare in the US has made inflation salient once again in a way that I think it's going to make fiscal dominance kind of arguments resonate less. When we were in the era of low interest rates and low inflation, people said, okay, you can spend as much as you want, it doesn't matter, we can keep interest rates low, inflation is low. But I think this has jolted the system quite a bit. And that is why, one manifestation of that is there are, fiscal hawks have once again become much more prominent in the United States. Let me give
Lost him.
We seem to have lost Arvind. Are you still there, people?
Yeah, I'm there. So, my perspective on that, until Arvind joins.
Sure.
See, the Yellen era and the early Powell era was not good for central bank independence. And if that kind of a era returns, then it would obviously have an impact on monetary policy and the fiscal dominance.
Sorry,
please go ahead. Yeah.
Yeah. So I was just giving one concrete example of that. If you remember, the dominant intellectual narrative espoused for the last 10 years was secular stagnation, right? There was secular stagnation, the view embraced by Larry Summers and Paul Krugman. It was then supported by Olivier Blanchard saying, interest rates are much less than growth rate, therefore you can spend as much as you want. Basically, debt and deficits matter less. But suddenly everything has changed. Larry Summers himself is become a bit of a fiscal hawk. So the whole secular stagnation paradigm has been kind of abandoned. People are beginning to get much more concerned about the fiscal. So I think that whole fiscal dominance fear has receded because of a combination of the inflation episode and how it has resonated in the political system, and the fact that people realize that in order to be able to spend more, unless you do some consolidation, it will have very bad consequences. So I think the fiscal dominance narrative, which was very strong even until a few years ago, or until before this recent episode, has to some extent intellectually receded in the United States.
So, Arvind, can I ask you one more thing, corollary of what was being debated? And I think you are just the right expert to answer that. And see, to me, I think the debt bubble is still one of the joker in the pack, which could completely disturb the macro stability which exists. And when I look at data very closely, I'm really worried at China. See, while you're quite positive on China, I'm really worried.
I'm not. I think China is
okay. So basically, if Chinese debt to GDP ratios to climb above 100%, would China have the financing capacity? Would it be unsustainable debt? Would it cause aftershocks of a kind, the spillovers, which one has never seen other than the global financial crisis? Not even pandemic has seen that. So does that worry you?
See, I think, the possibility of some big event in China cannot be ruled out. Uh, I, like most people, feel that, the Chinese government has the, fiscal firepower and basically just other forms of policy firepower to kind of prevent a hard landing. I think that's my view. They will throw money at the problem. They will, get people to fix it via non-policy means. So I think I think it's worrying, but I don't think it will lead to a major disruptive event. One. Second, I think it is still the case that a major disruptive event in the US and in the dollar system has far more international consequences than any major event in the Chinese system, because at least the Chinese financial system doesn't have as much of a spillover on the rest of the world. So that's why I think the question is very valid, but I think we will not get that major event because of the Chinese government's ability. And even if it were to happen, the international repercussions would be a little less than were it to happen somewhere in the dollar-based international financial system.
Good. I mean, I hope you're right. It helps us. India has to panic more also if China goes down.
Right. So, Tare, do we have any more questions, or shall we wrap up?
We have one more question, and before I go on the question, I want to correct my past attribution. It was Srijay Kanju from L&T, not Tech Mahindra, sorry. Our next question is from Ajay Kejriwal from Liberty Capital. Now, inflation targets are failing to be met, and it's possible that central banks lose credibility in the future in meeting these targets. Does it mean the inflation targeting is over? And we've had many paradigms in the past. We've had money supply, inflation, and so on. And the RBI has had multiple indicators approach before. What is the next idea for central banking?
And if I may add to that question to both of you, there was this narrative that there will be a soft peddling of 2% target by Fed at some point in time, because getting down from 3 to 2 is going to be extremely challenging, right? And as you mentioned, that the growth sacrifice in an election year is not going to be easy for Fed. So are we likely to see, particularly in US, some kind of a, more tolerance towards a 50 to 100 basis point exceeding over the so-called 2%, which is anyways not it's an FOMC interpretation. It's not a cast in stone kind of a mandate for Fed, right? Maybe Arvind, you want to go first?
No, let me do. He's handled the inflation targeting firsthand. So please, Mridul, go ahead.
Okay, thanks, Arvind. I mean, maybe you can add to the perspective given your insights so close to the Fed. So Fed, in clear terms, had indicated averaging. So to the extent that inflation has been low for long, it's willing to tolerate inflation slightly above the target. I think that itself will enable Fed to deal with the situation and keep 2% target. I don't think they will move away from the 2% target, because that will destroy central bank credibility. So for India, that kind of averaging is probably not necessary, because we already have a flexible inflation targeting framework. We have upper tolerance band and lower tolerance band. And it's interesting to push when we get repeated now communications, which were not occurring earlier, that the target is 4 and not 2 to 6%. But the last mile in India could be harder, because inflation could be sticky on account of food inflation also. And the food inflation shocks come pretty good, even if you have tamed the core inflation temporarily, we don't know how long that taming will remain. So the scare to have a growth sacrifice in India always comes back. And so maybe some more oscillation around 4 and tolerance could stay. Whether we need to be inflation nutters and push it to 4 on a very long endemic basis, I would say a balanced view needs to be taken. But definitely, if inflation seems to be going above 5, that crowds out the possibility of cuts.
So I think I agree completely with Mridul that the Fed is not going to change its target. One, but that's where Neeraj, your question becomes very important. Is that, but will it be willing to live with, even though it says 2%, will it actually exert itself to get it down to 2%, at least in the short run? I think that's a kind of an open question. I think that, if it de facto hovers around the 2.5, whatever, I think it will kind of live with that. But I think if it goes on for too long above the 2%, that's when questions will start getting asked. Because remember, it was because they were undershooting the 2 by so much for so long that they actually, unfortunately, revised the framework just before the inflation episode happened. And therefore, I think that experience will kind of be important going forward. That, yes, it will be fuzzy 2%. We call it flexible. I think it's more a fuzzy inflation targeting thing for some time. But if it persists for too long, then questions will start getting asked, and I think that's when we'll have to see.
Yeah, we can go on this topic because there are so many facets to this, but I'm afraid we've kind of massively overrun our time. If I were to quickly summarize what we've discussed today and very, very interesting conversation between the two of you, clearly on growth, it feels like that we are in a better spot than last year for this year. We expect that the growth will be better. On monetary policy, it feels like that central banks will be patient, and particularly in India, we don't have that much of a room and probably the need to cut. And if we don't need to cut so much, then will RBI cut at all is an open question. On some of the other external events, I think US elections clearly will be a big event. A lot of impact it will have on the markets and on the policy. But also the question that specifically was asked by Mridul, that is China blow up a big problem or likely to be a big problem? And I think Arvind's take is that no. It's a large economy. It is a very closed economy. So probably things will get managed, and hence there is lesser risk of China blow up, affecting the world market. So that's in substance where we landed up in this conversation. And finally, yes, on rupee, the fact that the asymmetric treatment of appreciation versus depreciation by RBI and accumulation of reserves is something that will continue, and hence we should expect some kind of a mild depreciation to happen. So that's broadly the sum and substance of this conversation. Again, very, very engaging and useful conversation. Thanks to both of you, Dr. Arvind Subramanian and Dr. Mridul Saggar. Back to you, Tanay.
Thank you very much to all our speakers, and we convey gratitude for your time and the benefit of your experiences, and of course the extra time you took out to talk to us and answer the questions. We look forward to our customers joining us soon for the next edition of Treasury Market Talks. We'll have a recording of this discussion available in case you wish to have this passed on to your colleagues, and do connect with your relationship managers for help on this. Once again, thank you all for joining us, to our audience. You may now please log out of the webinar.
Thank you very much.
Thank you.
To you and your colleagues.